Good morning. Hope you're having a good start to your weekend. Appreciate you taking some time on a Saturday to listen to me jabber on a little bit. But again, this is our Coffees with Kirk. I try to do these the first and third Saturdays of every month. So I'm going to continually do these. I know Saturday mornings aren't really good for a lot of people. But the beautiful thing is if you sign up for these and just ask to get the replays, even if you do it once, you should always continually get replays. So then you could watch it at your convenience or just listen to it whenever you want. So I appreciate you coming in. So today, let me jump in, throw the screen up. But today we're going to talk a little bit about, it's kind of a longer term theme, but I think there's already some of the short term. It's happening in the short term, the longer term theme that I've got. So we're going to talk a little bit about that, the big thing today. Okay. So if you've been watching these Coffees with Kirk for a while now, you'll know I've kind of got a general theme that's been going on that we're basically entering an inflationary period. Now, it might take a little while to do that. And the reason is what I'll explain today. It's a longer term cycle. I mean, we're talking longer term, like 50 to 100 year kind of cycle. So we'll jump into that. I'll kind of tell you some of the moves I'm making here in the short term. And then obviously I want to open it up to questions for people. So if you want to dig a little bit deeper and get some more context than what I'm presenting, these short presentations, there's a hedge fund manager. He manages the largest hedge fund in the world. His name's Ray Dalio. And you might have heard of Ray. He's in the media quite a bit. He's written a few books. But he does a really nice job of laying out the historical precedents for money, looking at trends of money over time. And it's if you just go to Google, put in Ray Dalio principles, it'll come up with a 4-part series. It's pretty meaty. It's really long, but you can really get a good understanding of a longer term cycle. Another really good piece from another capital management group, Artemis, it's called The Allegory of the Hawk and the Serpent. And essentially with that, what they're saying is the serpent kind of just goes forward, and then the hawk has 2 wings. And essentially the forward serpent is stocks and bonds, and that's what people know. But there's periods where the wings of the hawks are important to understand. The wings of the hawks are deflation and inflation. So I'm going to be presenting a little bit of that today, but I'm going to push that to a later presentation, because it too is kind of pretty meaty. I've been showing this slide for a while now, and this is sort of the battle that we're in. We have essentially built up the economy to the point where it really wants to deflate. We'll talk about debt levels, but when you get to a certain debt level relative to the size of the economy, the economy no longer functions normally. And in fact, it can never get to a good growth rate once it gets to a certain debt level. And right now, the debt level is about 3.5 times the size of the economy itself. So every dollar of debt that we add now, we get less juice from it. If you're starting off in your personal life and you have no debt, and you start to go into credit card debt, you can live a really good life. You can live a life well beyond what you're making in a salary. You can do this for a long time because the minimum payment for a credit card is 2% of the balance. So you can really live high in the hog for a long time. And then it sort of hits where that 2% just gets to be so big that you can no longer make that payment. Well, now you're going to be living, even if your salary had been going up over time, you're now going to have to live well below your means. Or you're going to default on your debt. Or you're going to have to sell other assets to pay off your debt. So that is all the deflationary reaction. And that's absolutely where we've been. And that's where we're at right now. We're going through just a massive recession, something that we haven't really seen as far as the damage, due to the COVID. But there were issues well before COVID. All COVID did was sort of pop the balloon. So I think my thesis here is going to be longer term. We're going to see some inflation because of the way the government reacts. But there's going to be a battle back and forth between inflation and deflation. So we have to be a little bit nimble. What will happen is the government will take action to fight off deflation, but they don't continue with the action and reaction. So they let things go a little bit and deflation creeps in because the economy wants to deflate naturally. So this is just a quick graph that Ray Dalio put out for a 50 or 100-year cycle. As crazy it is as it is, you'd think we would have learned from history, but we haven't. We've been going through these, and Ray does a nice job of laying that out. We've been going through these for centuries, and it just repeats. We're nothing more than just a big cycle. So the chart is really two things to look at. The first one, there's the smooth chart that goes up and then down and starts to go back up. And then you have the shorter term cycles. So even within this 50 to 100-year cycle, what you have is short-term cycles, 5 to 10 years. That's typically the normal period between bear markets that we experience. Right, 1981, and then we had a short one in 92, and then we had one at 2000, 2008. So that's typically your normal short-term cycle. And what happens in those short-term cycles? Well, you have an increase in debt. You get to the point where you have too much debt, and then the economy is no longer functioning as well as it should or growing as it should. And then you have deflation. So we go through a bear market. Debt is written off, comes back down. We get rid of the bad debt. We get rid of the malinvestment. We get rid of the companies that have been basically just living off of debt and not really producing. And this is good. This is a good thing. Recessions are a good thing, believe it or not, because what it does, it gets rid of the bad companies, gets rid of the bad debt, and then the good companies now can function. They pick up market share. They do a much better job. They grow. They build faster. It's a natural part. It's the forest fire for the economy. It keeps things functioning longer term. But the problem is we don't let the forest fire take its full effect, if you will. So the government, either through central banks usually or the government itself, steps in and tries to keep it so that we never really get back to the level we were before. So the debt level comes up, and then we have recession comes down, but it never reaches that bottom level that we were at before. If it did, we probably would get rid of these long-term cycles if they just kind of let things go. But we don't. So typically there's two ways that the government intervenes here. As the corporate debt is defaulted on, as we have deflation in the corporate debt, well, the government steps in and increases its debt. It doesn't want to see the total amount of economic activity shrink. So it tries to substitute, right? It comes in with infrastructure projects or these projects or this or that, trying to keep the economy from shrinking. And this has been going on forever, but it really, with John Maynard Keynes, he talked about how the government should step in when the private sector is struggling. And what that does is it smooths it out. And it seems like that would be the way to go. But the problem is, you never really fully flesh out and get rid of the bad debt or the malinvestment. You never get rid of that. And anybody that's ever worked with the government or even watched the government knows they don't use debt very well. I mean, you talk about malinvestment, that's the government. So the government steps in from a fiscal side where they'll do that. They'll increase their debt load. So you don't actually ever get a really big decrease in the level of debt. Secondarily, they do it through interest rates. So usually the Federal Reserve, the central bank, will bring their interest rates down. And eventually, after a few of these cycles, you end up getting close to a zero-bound interest rate. That happened in Japan in the early 2000s. And it's happening now in Europe and here in the US. We just get to the point, if you go back to the early 80s when we had double-digit interest rates, and it's just been coming down continually since then. And we've just gotten the point, even after every recession we've had, we never get the rates back up to where they were. They always kind of stay lower. So you continue this process until you get to the point where you're at zero bound rates in, with your interest rates with the central banks. But then you also have just a massive amount of debt that can't be offloaded because it's so much government debt. The government builds up a massive amount of debt. Right now, we'll talk about this in a second, but we're well over 130% debt to GDP. So the government has $1.30 of debt for every dollar of economic activity. So you just get to the point where the governments build up so much debt that we have essentially a reset, and they take certain measures to get to this reset that we'll talk about. Now, this just gives you a chart going back to the 1950s of corporate debt. And what you'll notice from this isn't a chart showing it go up in billions of dollars. So obviously, if it was 1950, you're going to expect that $1 billion of corporate debt today, it would go like this just due to inflation. Now, this is looking at corporate debt relative to GDP, the size of the economy, all the economic activity in the economy. So you can see all through this time, it's a one-way ticket up, even in the bear markets, which are denoted by the gray lines, the gray periods there. You can see it comes down a little bit, but it never gets back to where it was before that. So again, you continually have this increase in debt. This is a chart going back to 1950 showing total debt. So this is corporate debt plus government debt plus individual debt. And again, you can see we're at over 3.5 times our GDP. Whereas in the 1960s, we were 1.5 times. If you've been a client with me for a while, you've seen this graph. I love it. I don't know why, but it gives you a really good parallel to history. So the chart I just showed you before goes to the 1950s, late 50s, mid 50s. This one goes back all the way into the 1870s. And you can kind of look at the Great Depression right there in the middle. So what we saw in the Great Depression was essentially what we're witnessing now. And that's what kind of the point that Ray Dalio is making is we're really heading back to, another 1,500 year cycle. And the last one was back in the Great Depression. So we saw debt to GDP get to 3 times the level. So we're already well above the debt level back then in the 1920s. But this gives you kind of an idea of how things go. And that longer term chart that Ray produced, you can kind of see it here in a bigger perspective. We also had the debt load, which in today's comparison, it's not much, but you can see a big spike in the 1870s. After the Civil War, obviously there were a lot of debts from the Civil War, but then as soon as the Civil War ended, they started just going into massive debt, building the railroad out west. So that was another big panic that once they got through too much debt, and then they had a few years of downturn because of that. So I'm stealing from Ray Dalio here again, just to give you kind of an idea of interest rate and the money supply. So what's sort of the end game? The central banks get to a zero bound rate where they can't go any lower. You're at zero. And you get to the point where total debt is so high, including government debt. So, what do you do? How do you get out of that? Now, you could just let things deflate. We could just say, all right, we're going to let the economy deflate. We're going to go through just a really bad recession. Really bad. And then we just roll through it. And honestly, that would be the best thing we could do. I know, you never want to think that going through just a massive recession would be a good thing, but we would get rid of everything and probably be at a much better base, but nobody will do that. People start to blame politicians. Politicians don't like that. You get blamed for it. It's your fault. So they're going to try to do something. Well, that's what they've been doing for this whole long-term cycle, all the way back to the 1940s after we ended the last cycle. So what tools do they have left? And the only thing that they really have left is to, debase the currency. That's the only way that this thing sort of works out. And when I say sort of works out, it means it's not a deflationary recession, but it's just as painful to people longer term if you lose purchasing power. So you look at this chart, I know it's pretty busy, but you look at the interest rates, and back in the 1930s, we'll go all the way to the left. You can see the blue line, they got all the way down to zero bound. So they really had nothing left to do. You come all the way to the far right, where we're at today. And again, we're at zero bound on interest rates. So that blue line, see that long-term pattern, it came all the way down to zero, went back up, and then we've come back down to zero. So that's a long-term cycle. So we're there. So what do you do? So, well, the red line is basically showing you the monetary base. So what they do is they just try to depreciate the dollar. And the way they did it in the Great Depression was it was much more difficult back then because we were actually on a gold standard. So the gold standard, dollars could be converted. The gold price was $20.67. Well, eventually what FDR did is he just basically just changed it with the stroke of a pen and said, okay, the price of gold is now 35 an ounce. So what that did is it essentially took away almost 40% of the value of the dollar overnight. So you started to see that red line, the monetary base went up. So like anything, when the monetary base starts to go, when it starts to shrink, you have less purchasing power as an individual. It's going to hurt you in that aspect. It's also going to hurt some of your investments because if you're invested in bonds, they're going to lose value because the interest rate that you're getting is going to be lower than the rate of inflation. So we're now, you jump ahead here again to the red line on the far right, the monetary base today, and the Fed has basically jumped in with a massive amount of money. And the way they've done it this time was the monetary base jumped up a lot, because of all the programs. So, we had the whole CARES Act, everything with that, the PPP loans, all of that stuff was essentially just printed money. We were on pace before COVID to have a $1 trillion deficit this year for the government. Once COVID hit, we're now looking to add another $3 trillion on top of that. So a $4 trillion deficit. So essentially what you're seeing on this chart here is a $3 trillion increase in the monetary supply. And I think they'll continue to do that. Now, you might go back and say, well, why didn't we see that back in 08, 09 when the Fed, they brought rates down and they actually did quantitative easings. And I've done a presentation on this before talking about how the banking sector worked. What we had in 08, in 09 was that was sort of caused not by the individuals facing problems. It was the banking sector. We had a banking sector that had very little in reserves. They had about 15% in cash and treasuries, whereas the normal amount that you'd like to see, what they actually have today is 30% or more. So you had a banking system that didn't have a whole lot in the bank, and then they were making reckless loans. So the 08 crisis was really mostly caused by the banks, not by individuals. Now, you can say what you want, excuse me, about the government, but they did do a nice job of getting the banks to recapitalize after 08 to get it to a healthy position. What we have right now is a situation where the banks really they weren't the problem for this recession. They were pretty well funded and pretty secure, excuse me. So you had a pretty healthy banking sector. What we have now is it's the individuals that are causing the problems, and it is going to leak into the banking sector because so many defaults are coming. If you look at the earnings of the big banks right now, they are raising reserves. So they're not loaning much unless you have really good credit. So they're cutting their lending, and they're just putting money into they'd make a lot more if they could loan it out at 3, 4, 5% for a mortgage or higher for credit cards or things like that. But they're so afraid that now the individuals are going to cause a banking crisis, and that still could very well happen. That's the problem that we're looking at. I know last week a client asked about should we invest in banks, and the biggest reason you don't want to do that is because of what banks are looking at. Banks came into this thing looking okay, but if we as consumers have problems, if we're defaulting on our mortgages and our debts, our credit cards, our car loans, all that, well, now the banks have a serious problem. They're looking at defaults just because of what's going on in the economy. So the 08, they took measures. The Fed basically injected a lot of money, about $4 trillion, but it mostly stayed on the banking side, the liability side of the banks. So they never had, it never really got into the economy, if you will, to cause price inflation that like we would notice going out shopping, going to the gas pumps, things like that. It stayed to liquefy the banks. Well, this time the Fed is now creating a situation that's getting into the economy. It's getting into our hands. Again, I did a longer presentation on this, but when it happened with just the banks and it stayed on the liability side or the asset side of the banks, it didn't create expanding money supply, because all it did is the Fed took bad assets off of the bank's balance sheet and gave them fresh cash, made them more liquid. What we're having now is it's getting out into the regular economy. You know, the $1,200 stimulus check you got, the $600 per week extra unemployment people are getting. Goods and services, that's going to drive up prices. Demand increases, supply stays the same, prices go up. So that's what we're kind of seeing. I'm sorry to stay on this too long, but it's kind of an important point here. So this is basically what they're going to do. And they're also, the other thing that they're going to do, and this is also something that FDR did back in the Great Depression. So you have a point now where they're going to try to just inject tons and tons of money into the economy. And that economy, it's going to be us getting it. So it's going to be all kinds of government bailouts, all kinds of government programs. It'll be infrastructure projects. It'll be everything. But at this point, rather than foreign countries and foreign investors and individual investors putting money into the treasuries, it's essentially going to be the Federal Reserve just printing money to do it. But what they're going to do with the bonds don't go up beyond a certain level. I don't know what that is for this Fed, but back in the Great Depression, the Federal Reserve kept the 10-year rate. They would not let it go above 2.5%. And then the T-bills were capped at 0.65%. So anytime that bonds, the market started pushing bonds above that level, the Fed would come in and just print money and buy government bonds. So they created yield control. Well, the problem is if you're pumping in tons of money, you know, back in the Great Depression, it was all the programs that, that FDR had created, you know, to build the dams and to, you know, build the roads in the Tennessee Valley, all that. And today we've already got the CARES Act, but we're going to get a lot more coming. So you get price inflation because that's getting out into the economy, but they're going to cap the interest rates. So what this shows you real quick is what the 10-year Treasury rate was relative to what inflation was. So in the early 40s, you see a huge spike in inflation. Now that was partially due to obviously the war. The war effort demanded a lot more iron, coal, rubber, all the, you know, steel, everything like that. So demand goes way up, supply stays pretty relative, prices go up. So that was inflation. After the war, prices came back down. But then we had essentially the end of World War II, really into Korea, again, inflation. But what you can see is the yields didn't go up. So just to give you an idea, over that period of the last chart I just showed you, into the early 40s to early 50s, had you put $10,000 into treasuries at the start of it, it would have grown to $12,694. But due to inflation, you'd only have purchasing power of about $6,700. This kind of gives you a year by year graphical chart of what your total return would have been for a 10-year treasury relative to inflation. So you can see, when all the way through the 40s, you were kind of losing money relative to inflation. And then, of course, in the 70s and 80s, when rates went way up, if you were investing in treasuries then, it was a good return, double digit. The other thing that this does and creates a problem which causes the government to act, the reason that they would never, ever just sit and let things deflate and correct on its own, the natural way, the way capitalism should work, in every period, these things end up with a really big wealth disparity. And we're seeing that again. This chart shows you how the wealth inequality was there in the 30s and it's there today. And this, again, people talk, well, capitalism failed because we have wealth inequality. That's not true. This is just a natural cycle, which has been exacerbated by which really is socialist actions. The government stepping in and just printing money, the government spending, things like that, trying to smooth things out, tweaking with the wheels of capitalism. And it causes this. So what we're seeing today out there, the chaos, you can argue it's racial, and certainly there's a component of that, but at the end of the day, it always comes back to the Benjamins, right? It's always about money. So you have a situation where people see a very wealthy dynamic for a small percentage of people, and they're not getting their piece of it. So it creates tensions. And this is probably only going to continue, quite honestly. If you want, this is sort of an aside, but if you want to read a really fantastic book, it's called The Fourth Turning. Neil Howe is still alive, but there's two gentlemen who wrote it, Neil Howe and then Strauss. I can't think of his first name. What's his first name? Not Levi Strauss, that's the jeans. I can't think of Strauss's first name. But anyway, these two gentlemen basically have a theory, and it seems to be playing out, that every fourth generation, every fourth turning, you get to a situation like this. And it kind of matches up with Ray Dalio's long-term trend. Ray was just looking at money and the economy, whereas the fourth turning is looking at the generations. So they go all the way back to the revolution, and then you go 4 generations from there, we hit the Civil War. 4 more generations from there, World War II, the Great Depression. And now we're again at the 4th generation. And these guys wrote this book in 1995 and said that basically by the late 20 or early, 2005 to 2020 is when they said that everything was going to kind of fall apart. That was their prediction. And it seems like they're pretty much right on. And the way to describe it, what goes on, it's uncanny. So again, we're just kind of going through something that's happened several times. So what I'm trying to do is get an idea of how do you navigate that from an investment standpoint. This chart again kind of shows you, just gives you an idea of just the amount of government spending that's going to take place. As I mentioned, we already were on pace for $1 trillion deficit. We added 3 more on top of that so far due to the CARES Act. And if they do something else this year, we're looking at least another $1 trillion probably. So the government debt relative to the size of the economy is going to be easily at 130%. Once a country gets past 120% debt to GDP, there's really no way back. There's really no good answers. You're looking at either a big deflation, or you're going to look at them trying to inflate away the currency. And the bad thing is, as bad as these numbers look right here, this doesn't even get into some of the things that I've talked about previously. When I talked about the 4 horsemen, and one of the biggest ones was unfunded liabilities and demographics. So we are facing an unprecedented amount of unfunded liabilities for Medicare, Social Security, for government pensions. All of that stuff is going to create just a massive amount of debt. And I just don't see the government ever saying, no, we're not going to meet our obligation. They're going to meet it, but they're going to meet it with dollars that are worth a lot less money. So the amount of, we're talking about 60 trillion of unfunded liabilities here over the next 25 years. That's just massive on top of what we're already going through. So there's no exit strategy here. This is just a chart showing you how the total number of people paying, Social Security is nothing more than the money comes in, the money goes out to the people who are receiving it. So you can kind of see it, the number of people paying in is shrinking, and it's going to continue to shrink. So the point is just going to have to be government debt to make this thing work. This is government pensions at the state and local level. They're at the point where there's just no way that they can do it. Now, technically, the federal government should tell the states, like, look, you made your bed, you're going to have to lie in it. But they're at a point now that they don't want anybody to feel any pain. And the Federal Reserve just figures, hey, we can just print the money and make this work. So I kind of continue to see, I think, as much as if I was in South Dakota where we had no debt whatsoever, I would be very upset having to bail out Illinois or New York or Pennsylvania or California, their pensions. That's not right. But I think I just don't see the government actually, anybody stepping up and going, nope, you made your bed, you're going to lie in it. This gives you an idea right now of just government transfer payments. So this is money that's going out into the economy directly to people. This thing obviously spiked massively when the coronavirus hit, just because of the extra unemployment insurance, the $1,200 payment, the PPP loans, all of these things that they've done has just created a massive amount where people are just relying on the government right now. So again, I'd love to see us just jump right back to where we were and the economy just starts rolling. But I don't think that's going to happen, especially with unfunded liabilities coming up. Okay, so that's the overview. So where do we jump into this? And this is where I took this from Artemis Capital Management. And what they're arguing, and I kind of agree with it, is the typical 60% stock, 40% bond portfolio, which has worked so well for so many years, is really going to face some struggles. If bond yields are going to be suppressed by the central bank, they're not going to let rates go up. Well, go out and try to find some interest right now at a bank or even bonds. It's very difficult. So you're looking at lower returns in bonds. And then you're also looking probably lower returns, although inflation, stocks will go up with inflation, but you're not going to go up as fast on an after inflation standpoint. What this thing shows them is really 90% of the 60-40 portfolio return has taken place from 1984 to 2007. If you look at this, it looks at the 1929 to 46 period. If you'd have put $1 at the beginning in 1929, in 1946, your dollar would have been worth $1. So you would have gotten nothing out of that. And then you had the rebirth, like the baby boomers from 47 to 63, $1 invested in the 60-40 portfolio at that time. By the time it got to 1963, it was worth $3. Then you had mid 60s until the early 80s when we had massive inflation. We had interest rates going up, and we had two big bear markets in stocks. Again, what you're looking at there is pretty much a flat return over that period. But then we hit the early 80s, and you had interest rates were all-time highs. And as they came down, even if you'd invested and held it, you got a great return, double-digit return. But even as they came down, bonds got a capital gain. So that was a boost. So you had bonds that were doing very well. And then the stock market started off at a price to earnings in 1982 of a single digit. It was 5. So again, price to earnings, you just take the price of all the stocks in the market divided by the earnings of the market. And the theory behind that is that when you buy a stock, the price you pay, you divide it by the earnings. And that P&E tells you how many years would it take to get your money back completely, ignoring any kind of earnings growth. So a P&E of 5 meant in 5 years, your money would double. You'd get all your money back. Your original money would come back to you. So you had a low P&E. Now we have a very, very high P&E. We're pushing 30. So in theory, it would take you 30 years to get your money back. Last week, I talked about the tech stocks. You have tech stocks. Shopify is a hot stock. It's trading at 3,600 price to earnings. Amazon's at 2,000. I mean, there's things like that are going on that doesn't make a whole lot of sense. But there are some stocks, some value stocks that are more reasonably priced. So what this is saying is, maybe the 60-40 portfolio, which has been the bread and butter pretty much for everybody who's watching here for most of your investing life, early 80s, at least 30 years of it, it's not going to work as much. And again, this Artemis says you got to look at the wings, the inflation and deflation wings. So, longer term, we have to look at some asset classes that probably are typically things that folks would invest in, and we'll talk about here in just a second. And I think right now it's, as I mentioned before, that sumo wrestler deflation, inflation battle. Well, we kind of have the inflation's working right now because if you look at what the dollar is doing, the dollar will tell you a lot. The dollar is losing purchasing power right now. It's kind of back where it was at the start of the year, but it's definitely declining. You can see a lot of asset classes that move in the opposite pattern of dollars are doing quite well. This is what I use to kind of get a feel for where we're at as far as the economy. So back earlier this year, we were definitely in a deflationary. The markets were dropping, inflation was decelerating. The Fed was very accommodative. So it was certainly what we call quad 4 deflation. Things were really bad, but it's kind of moved to the quad 3, which is stagflation. So you still have lower growth. We're not getting, growth has bounced from the bottom, but it's still well below what it was in previous years when you look year to year. Now, but we've got inflation starting to accelerate. If you look at commodity prices, if you look at gold, things like that, if you go to the grocery store right now, you're going to see prices are getting a little bit more expensive. Now, the monetary policy is dovish, and I think it's going to stay that way, but we're kind of in this quad 3. And then this is a very busy chart, but it kind of gives you an idea of what are the good sectors in each of the different quads. Right now, quad 3, tech is usually a pretty good one in quad 3, but I'm not going heavy into tech. We'll have some tech, but I'm not going heavy into tech because it's just so ridiculously overvalued. Look at my last presentation if you really want to see it. But things like utilities in energy, commodity-based stuff is going to do pretty well. On the bond side, inflation-protected bonds, I'm going to add. We've always had a little bit of allocation to that, but I'm going to add a lot more to it. Long duration treasuries will probably do pretty well right here. Value stocks, I think, are going to do pretty well. This gives you sort of an idea of, on the bond side, I'm going to add quite a bit of inflation-protected bonds. The way inflation-protected bonds work, they're a little bit different. A normal bond is you loan, say, $10,000 to the government, and they're going to pay you an interest rate, 2%. So you get that 2% for however long, 10 years, 20 years, 30 years. At the end of the term, they give you your $10,000 back, and you've been collecting that 2% every year. Now, inflation-protected bonds are a little bit different. You don't get as high of an interest rate, but your $10,000 that you invest adjusts every year by inflation. So you can always sort of look and compare normal bonds to inflation-protected bonds. And if we had a normal market, the 10-year Treasury should be at about 1.52% to hit the break even with what you could get in Treasury inflated protected securities or TIPS or inflation-protected bonds. So it's quite a gap there. There's about a 1% gap that you can get going into inflation-protected bonds versus traditional bonds. And I do think that if we are really seeing maybe a longer term inflationary move here, talking 10, 20 years, inflation protected bonds are going to be pretty integral for you to protect your purchasing power. Another big thing is obviously gold, silver, all the precious metals. I'm putting this up here. Everybody knows Warren Buffett. Buffett has been a basher of gold his entire investing career. He hates it. absolutely hates it, never liked it. This was the quote that he's most famous for talking about gold. You know, you dig it out of the ground in Africa, you melt it down, you dig another hole, you bury it, and pay people to stand around and protect it. He goes, why would you do this? You know, if anyone watching from Mars would be scratching their head. Interesting. I just last night, after the market closed, Berkshire released, Berkshire Hathaway, which is what Buffett runs. It's the insurance company he owns that invests in companies. It released its recent holdings. And interestingly enough, Buffett bought Barrick Gold. He bought a gold miner. He's never owned a gold miner before, ever. But he bought Barrick Gold. It wasn't a huge position, but just the fact that he's taking a position is alarming. The other interesting thing that he did is he basically sold his positions in banks. He sold Wells Fargo. He sold Goldman Sachs. He sold PNC. So he got out of the banks, which is interesting. Again, banks were coming into this thing looking pretty good. But I think Buffett's looking at it and saying, look, there's going to be some pain here as defaults and everything like that starts to get through the system. So that was interesting. So I threw this up here because obviously gold is something that we'll be looking to add a little bit more. I've always had a little bit to gold. If you've been a client for a while, I've always had a small allocation of gold just because it's a good insurance policy. But I think it's going to make a bigger portion of portfolios over the ensuing years. And that's going to fluctuate, inflation, deflation. But gold is a very good inflation hedge, but it's also, believe it or not, a good deflation. So even if we have a massive deflation, gold just doesn't do well when things are kind of humming along okay. We don't have massive inflation. We've got good growth. Gold's just not a place to be in that period. That's why gold did so poorly, really from when it crashed in the early 80s until all the way up until the mid 2003, 2004, mid 2000s. It did nothing because things were going good. That 60-40 portfolio was rolling, but it does really good on the tails of the hawk, if you will. This just gives you an idea in the 1970s and then the 2000s, what asset classes kind of do well with weak dollars. And emerging markets, because they're very commodity based, they do well in inflation. Commodities do well, value has done well, things along those lines. And obviously, gold. Commodities are really at historical lows. This gives you a chart showing you basically comparing it to the S&P 500. So the top of the chart is when commodities have been expensive relative to the S&P 500 or the stock market. And then you go down to the bottom, that's when commodities have been very cheap relative to the S&P 500. So like anything, you want to be, everything goes in cycles. If you get nothing from this other than the world moves in cycles, it does that in investments as well. So you can kind of see that right now commodities are at basically the lowest point relative to the stock market that's been, going all the way back to before the oil crisis of the early 70s. So it's probably a good place to be. They've gone nowhere for a long time. And if we are going to see this inflationary, if we're going to have money printing, it's like anything. There's only so much copper. There's only so much oil. There's only so much gold and industrial metals and livestock and grains. So if you have more money, more dollars chasing that same supply, price is going to go up. This is another chart for gold versus the stock market. Same kind of pattern we can see. The little small blue line is the 50-month moving average. So it's over a 4-year moving average. So you can kind of see when this thing breaks below that 50-month moving average or above it, it really moves. So we've just gotten to the point where gold has broken above the 50-month moving average relative to the stock market. Last time it did that in 2002, it had a phenomenal run relative to the stock market. It doesn't mean that's going to happen again, but the chart's at least shown that right now. Same with value stocks. So growth stocks, I talked about a couple of weeks ago, just tech. I mean, it's unbelievable what people are paying for tech. And it's gotten to, where 5 stocks make up over 20% of the stock market, the S&P 500. It's ridiculous. So value stocks, you have growth stocks, tech stocks, things that are growing quickly. And then value stocks, they could be things that are either beaten up a little bit for some reason, just something the company did itself and they got smashed and now it's kind of offering compelling valuations. Or it could just be industries that are overlooked. Typically, these companies are pretty good cash flow companies, pretty good dividend companies, but they're just not sexy. It's just not sexy to buy some of these stocks. But what you have is a historical rotation between growth and value. And right now, the valuation metric, value has never been cheaper relative to gold. I'm not saying that value is really cheap, but relative to growth, yeah, it is. If you go all the way back to 2000, when we hit kind of the last peak, if you'd invested in value stocks in 2000, when the market had a 3-year bear market, value stocks actually made money over that period. So you didn't lose any money if you went into value, but you did if you were in the growth stocks and the tech. So those are the things that we're going to start to add. We're still going to have some long-dated treasuries, a lot of those. But I'm going to add a lot more to inflation-protected securities at this point. We've already got some what they call tips. We're going to add more to it just for protection. I already got some gold. I'm going to add a little bit of silver. Silver is picking up. Silver isn't quite the precious metal. It's really not the dollar counterbalance that it used to be. It's just not seen that way so much. But it is picking up. And the thing about silver is it is one of these that it does nothing forever. And then it makes massive moves one way or another. It makes massive moves down, but it makes massive moves up. And it's starting to percolate up at this point. So I'm going to add a little bit, probably 3 times as much gold to the silver that we add. But then the other thing is just that the mining companies are in royalty companies. So they're also companies that they don't really do the mining, but they loan the money to the miners so that they can do the mining. And then they get an interest rate back plus a portion of the gold price. So if gold and silver are going up, these royalty companies are really in a sweet spot because they're getting the interest rate for the debt, but they're also getting some of it tied to the price of gold, which is going up. So we're going to add some of that. I'm looking at Bitcoin, but I'm just putting that out here. I'm continually trying to put this in the back of your mind a little bit. On the first Saturday of September, I'm scheduled to actually do this with a gentleman who he runs Bitwise Asset Management, where he's the head of research. He's been a friend of mine since early 2000s. He basically did all the research as the ETF market was growing. I've been using ETFs since the early 2000s. And so I've been at conferences and got to know him really well. And he did all the research there and he moved over now to cryptocurrencies. And so he's going to do basically a presentation. We're going to do a Q&A. On the open market, there's no SEC regulated investment. There's one over-the-counter investment that does cryptocurrency, but the problem with it is it trades at such a massive discount or a premium. And right now, the premium, like you're going to pay 20% above the price of Bitcoin just to buy it. So it's not really all that feasible right now. But commodities, we're also going to add some to commodities, broad-based. I'm using a holding. It's the Aberdeen Goldman Sachs Commodity Index ETF, and it's got about 15% to oil and natural gas, 15% to precious metals, 15% to grains, 15% to livestock, and then industrial metals. So it basically gives you the full gamut of the commodity market. Value stocks are another thing I'm going to look to add. I've always used this strategy I've loved called dogs of the Dow. So you take the 4 losers from the previous year on the Dow Jones Industrial Average, the stocks that did the worst. So that typically these have the lowest price and highest dividend yield. And if you did that every single year, what you typically find is you add 3 or 4% above what the market does. but at the very least, you're getting good yields. So right now you're getting Dow Chemical, which is the 8% dividend yield, Walgreens, which is almost a 5%, Verizon, which is close to 5%, and then what's the fourth one? I can't think of the fourth one on the top of my head. So, things like that, but also going to add just some value. And then emerging markets for some international. I'm still not going to go back into the Western Europe or developed Pacific like Japan, Australia, things like that. They're still struggling a little bit, but the emerging markets are probably going to do pretty well in this environment. Okay, so I always have to do this because it's not always just clients that's come into these things. So I have to say, hey, the lawyers say, hi, I'm posting this. I think that the data I'm providing is accurate. This is not financial advice. So make sure you look at it yourself or your client. Obviously, I'm going to make these moves, but if you're not, do your own research, blah, blah, blah. Okay. So let's see what questions folks might have. If anybody has any. Got a few folks. We got folks in from Tampa. We got folks in Western Shore, Eastern Shore. Oh, cool. So does anybody have any questions on things I present? I know it's a lot of information out there, but it's a longer term cycle. And it's not, I don't think it's one of these that we can just throw money in these assets and let it go, because there's going to be that inflation deflation. There's really a pretty good argument that right now that bonds are the place to be and not stocks. Some of the gentlemen I follow, some of the market historians and economists are kind of saying that. And I do kind of think that, because I've mentioned, this is a bigger recession than what you thought. The first part of the recession was mostly liquidity, people freaking out, worrying about liquidity, things drop, things come back, but then you have the solvency crisis. And that's where we're at. We have 30 million people who aren't paying their rent or mortgages. We have, credit card debt, auto loans, all this stuff is pretty tenuous, especially if the jobs don't come back. So we're going to start to see some real issues on that. If this turns into a solvency crisis, it doesn't really matter so much what the Federal Reserve does, because if they're buying these bonds, they're just going to lose value. So you could still get a serious deflation. It's a sumo wrestle, right? It's going to be a battle. It's an accordion. It's going to keep going back and forth between inflation and deflation. But ultimately, I think the longer term is we're probably going to see things that really devalue the dollar. That's the way governments do it. Governments love to just lower interest rates, increase their debt until they can't anymore. And then they have to figure out a way to devalue the dollar, which really is bad for you and me. But that's typically what they want to do. Okay, so it doesn't look like there's any questions. So I thank you for your time. Like I said, next presentation will be the first Saturday in September. And I'm going to probably do that with somebody who does the information for Bitwise Asset Management, just to kind of give you some exposure to that. I know Bitcoin and all these cryptocurrencies are really confusing stuff, but anything with a finite supply that is deemed in any way as a monetary usage is probably going to do pretty well relative to the dollar. So we'll talk about that. So with that, I hope you all have a great weekend. Take care.